So the Bank of England has put interest rates up again, and just as everybody's bracing themselves for cooling down the property market, or maybe even a correction or a crash, they've come out and done something totally contradictory to what they seem to be trying to do, in my opinion, and that is remove the affordability of mortgages on the stress test. So remove that stress test affordability. So in this video, what we're going to discuss is the base rate rise, and we're also going to discuss removing affordability and what this means for us as property investor, the property market as a whole, and what we need to be doing moving forward. I'm going to give you 3 actionable steps. Make sure you stay here to the end, because one of the reasons they're raising the base rate of the bank rate is because of inflation. So we're going to give you a little gift at the end. If you didn't catch up my last video, we're going to give you a little gift where you can get a £400 gift towards your energy costs. So make sure you stay here to the end, and while you're here right now, it's smash that like button, that subscribe button, and that bell icon, and let's get into this. So for the 5th consecutive month, the Bank of England have raised interest rates by another 2.5%. So it's now at 1.25%. It's the highest it's been since we come out of the last crash. And ultimately, 6 out of 9 people voted for this raise. The other 3 people actually wanted to raise it even more. They wanted to raise it by 0.5 and raise it to 1.5%. And the reason behind this is to try and curb the inflation. Inflation is around 9% at the moment, but they are predicting that we're going to hit potentially 11% in October when we get this energy cost jumping up again. I'm not going to go too deep in inflation. You can see another video here where I talk more around that, but this is their tool to try and counterbalance this. In The Guardian, a little article around it saying the increase is only guaranteed to be passed on to borrowers with home loans that rates are explicitly linked to bank rates. So basically tracker mortgages and some lenders that have got variable standable rates there. So for example, Santander has a thing called a follow-on rate, and basically it is 3.25% above the base rate. So this is going to put their follow-on rate to 4.5%. So how is this going to affect households? We've already got ever increasing costs in fuel, in energy, and if the mortgage rates start going up, obviously it's going to put a bit more of a pressure in place. They're predicting that how it would affect this. So the increase in base rate to 2.5% is set to affect homeowners on variable rates, as well as tenants and people on fixed rates. And the reason they're predicting that is obviously tenants are going to be affected, because if landlords are getting higher rates, they generally pass on cost to tenants. People on fixed rates are going to be affected, because when they come to the end of their fixed term, it's really going to have a knock on, or it's also going to have effect. It potentially could have had an effect that people stuck on fixed rates are not going to move home, because they're going to think to themselves, okay, I'm not going to, like, if you move home, you give up your fixed rate and go on to a new rate, which is potentially going to be a lot higher. Some people might even be under 1% or 1.25% what the base rate is at the moment. The average cost for those on a variable standard rate is going to be about £191 per household, and that's £303 according to industries bodies of UK finance. So it's going to have a massive squeeze alongside all these other increasing costs. There's a lot of predictions as well that the base rate is going to hit 3% by the end of the year. So again, putting even more cost on our cost of living. But in a complete U-turn, yesterday the Bank of England announced, or yesterday after recording this, the Bank of England announced they're going to ditch the affordability test. This affordability test got brought in after the 2007 crash to make sure the banks didn't irresponsibly lend to people and basically stop us heading towards another property market crash. Look, just because they put this in place, a lot of the articles are saying doesn't mean they're going to implement this, and a lot of banks have been pretty cautious of the way they lend anyway. Even within the lines of where they're at, they're still very cautious. They want to know everything from you at the moment. But this, for me, could only spell danger if banks loosen up, because the thing is, there's massive competition. I've noticed the mortgage works have reduced their rates, even though the base rate has gone up, and they've opened up another product with a light refurbishment product. They're always in competition with each other, because the lending is such a competitive market. But look, current stress tests work on a high standard variable of 3% above the standard variable. The test was part of the recommendations made by the 2014 in the aftermath of the financial crisis, so it's put in place for a good reason. This is why I think the banks are pretty strong, the market's pretty strong, because there's not been a ton of irresponsible lending, and the people have been stress tested, so they've been the banks have been factoring in rates going up anyway. Lenders will adhere to a loan to income limit flow still, so they're still going to look at the loan to income on that. I don't think they're going to go back to the times of 07 in my opinion and be loosely lending you. I remember one of my friends went in, he kind of was self-employed, he went to a broker, I'm self-employed, I said, how much do you earn? He went, around 20k a year. The broker just said, let's say you're on 30k a year, that'll give you a better mortgage. I don't think we're going back to those days, but this has got to be monitored. So Lewis Shaw of Shaw Finance Services said the change will increase demand, pushing up house prices while taking out any sort of stabiliser in the market. We are already got a huge supply side problem, so if they fuel demand further by making it easier to borrow large amounts, that can only push prices one way further. This is what this Lewis Shaw is saying. And I can only agree, there is a supply and demand problem of both a lower supply of properties, but also a high supply of money at a cheap amount. So again, no matter how cheap the money is, if you lend people money, they'll think about how they pay that later on. So if you make lending looser, it does push prices up, and past has showed us that. But ultimately, just because these places have been put in place doesn't mean the banks are going to go down that route. I still feel the banks are still going to want to know what the inside measurements of your leg is, whether or not you've had steak for dinner last night, or whether or not you've been circumcised. That said, there's a little bit of a joke in there, but the one in the middle, they do ask how you spend your money. Do you go out? I still think the banks are going to lend fairly more responsibly. I think this is a bigger move to try not to rock the housing market too much on a sentiment base. So in my views, and it's only my views, nobody knows for certain, I think a lot of this is driven for the sentiment behind the market. I think the base rates jumping up to where they've jumped up to is not a massive damage. Like, I'm not getting major difference in my mortgages at the moment. I think it's the sentiment's going to damage the market more than the base rate. To be fair, it's been absolutely for nothing anyway, the lending anyway. So 0.1% it went as low as. Even at 1.25%, it's still incredibly cheap borrowing, especially when you look at the long-term average, and the long-term aim for their average is 5%. So I don't think I think the sentiment would have impacted the market more, and I think this move from the Bank of England is to help with their sentiment. I still feel they're going to be tight around their policies, but only time will tell. You never know, they might start giving you loans and just asking the brokers go back to the times when they ask you how much you earn, and you just throw a random figure in and they just give you money. I don't think that's going to happen, but nobody knows for certain what's going to happen in the market. You've heard me say this loads of times. You watch my previous videos. Time in the market beats time in the market. We can get indicators, but you can never time markets right. So you always want to be buying throughout markets, and cash flow's king. Getting high yielding, strong cash flowing assets that can be covered by housing benefits. As we're talking at the moment, bidding on a block of 6 flats. Nearly got the offer accepted. Just got to send over proof of funds straight after I record this. And the thing for me is, the rents are going to be £450, £500. Benefits can cover that at £425. So this, when I talk about my property delta matrix, really works in well. It's foundational stuff in there. And even if I don't get the end values, I can afford the drop off and the money I'm going to leave in there. I can afford to tie it up, and it's going to give me a great return on my capital. So cash is not always king in these circumstances. You do want some cash to invest, and you want some reserves, but you want cash flow. Cash flow is going to be king to move through these markets. Few things you can do to move through these to protect yourself in these markets is, number one, take long-term fixes. So at the moment, I'm bridging this. We've got to do a light refurb. It's already tenanted with six apartments. It's about a 20-year-old build. So we'll do a light refurb on that and put it on a long-term fix. So we'll fix that at 5 years minimum, maybe even longer, because I'm not worried about recycling after that. The second thing you can do is not over leverage. So maybe if you're concerned, get a 70% loan to value instead of 75%. As I said, TMW are given 80% loan to value, so maybe just go at 75 at a max, but don't over leverage. Don't over leverage based on these overinflated prices at the moment as well. Depending on what end of the market you're in, make sure you give yourself a little bit of cushion in there if prices drop. And the third thing you want to do is stress test yourself. Even the banks are not willing to stress test you. Make sure if the price drops, if you get housing benefits for this property and the tenant loses their job, can it be covered? Second thing is, if you go onto a variable standable rate and it's at 3% at the end of the year, Can you cover that, whatever that might be, 6, 7, 8%? Can the deal cover that? And if you do those three things, you're going to stay in the market for that time. Like I said, time in the market is going to definitely beat time in the market, and you can continue to gather that cash flow. As I said, if you stayed around to the end, there's a little thing you can do. The government are giving out £400 towards energy bills. We're going to put the link below what you have to do to register for this. This is a gift to everybody to help them out with high inflation. Inflation is the reason why we're in this situation. The excessive money printing is the reason majorly behind this inflation, mixed with the conflict we've got going on at the moment. But we're at where we're at, so do not sit on your hands, do nothing. Just navigate these, take the protections, what you need to take, and move forward, creating cash flowing assets. Cash flow is going to be king moving forward in any environment, whether the markets are going up or down. So listen, my why is to live my terms. My mission is to help as many people live in their terms using property, financial education, mindset as a tool to do that. So please share this, please like and subscribe, and hit that bell icon so you get notified when we do more videos like this. Please put in the comments what your views are, where you think the market's going to go. And listen, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.